My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people don't make friends. I'm just trying to make a little money. My job is not to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. We're in a weird moment where stocks could be hostage to the Fed and inflation, but maybe they'll be freed by the stealth forces of technology. We're worried about it. Inflation, no doubt about it. But we're hopeful about how artificial intelligence can bring all costs down. We don't like housing prices staying stubbornly high, but we see how Amazon can bring down the prices of drugs and groceries. That's how I've come to view this market during a week where we get the producer price index, tomorrow's game, and the CPI on Wednesday. Today, we're pretty sedate, though. Dow dipping 81 points, S&P declining 0.02%, NASDAQ advancing 0.29%. We did break the Dow's 8-day winning streak, though. The last down day was April 30th, and that's pretty darn amazing. Of course, we don't want to look at this moment as a dichotomy. We want so much to say, sure, the drug prices haven't come down all that much, but have you looked at BioHive 2? A new AI supercomputer powered by NVIDIA hardware to speed the work of scientists in healthcare, which was introduced today. Have you seen what Recursion, the NVIDIA-backed drug developer that we had on Friday, is going to do with it? Maybe they can use this machine to speed up discovery and development time. Remember, every second counts when you're on the patent protection clock for a drug. You can only imagine how many hard-to-cure illnesses can now be beaten because we have the ability to analyze data so much faster. Years to months, months to days, days to hours. It's a game changer no matter what. Don't get too carried away with that near term. It's not a deflationary hope. It just isn't. See, you can't get carried away because rents, far more important for the CPI than, say, drug prices years out. Rents won't come down in price. Perhaps that's because we have high immigration, with maybe 500,000 people with work visas and the rest housed by state and local governments wherever they can find space. We don't know how many work permits have even been given, but obviously more people means more demand for housing. On the other hand, immigration is one of the things that keeping down wage inflation, but that's not something the consumer needs to care about. But wait, before you get too negative, wait 1 second. Have you played with Chat GPT 4o, the O standing for Omni? It has amazing capabilities in text, video, and audio. It can perceive your emotions. It can read bedtime stories with feelings, be more dramatic, more musical. Yes, it can sing the story. It can translate with correct intonation, not flat the way you'd expect from an AI bot. And it can even handle being interrupted. Come on, that's amazing. Oh, and by the way, two times faster, 50% cheaper. That's phenomenal. But how does that program that can sing a bedtime story build enough houses to push housing prices and rents lower? Is there anything in the Amazon toolkit that can put up a house quickly? Can you get one from Prime via next day? How about same day? Sure, home builder contractors can coordinate the roof with the gutters and the siding if everyone has an Apple Vision Pros building a house, but they don't. And they won't because it's $3,500 price tag. You want to Google a cheap house? It can answer a query, but it can't build a new one or even remodel an old one. You can use it to learn how to do plumbing, but don't do electrics. It's unsafe. Meta can't build a house either. I mean, Meta can tell you what your friends are up to, but how's that keep inflation down? None of the hyperscaler titans, as rich and powerful as they are, can keep insurance rates from going higher. None of them can build more used cars. They can help you find cheaper apparel, but that apparel is probably not included. Yes, they can do it, but it's not included in the CPI. You know why? Because it comes from China. It's Temu. We keep thinking that accelerated computing and generative AI will solve so many of our problems, and eventually they will. But the emphasis is on eventually. In the near term, it won't have any impact on the stuff we're worried about that's front and center, not in a time frame that matters to the Fed. Yeah, I had to reminisce about that. It's kind of like when we started TheStreet.com in 1995. We got money from this outfit called Starwave. It was founded by the late Paul Allen and led by this terrific guy, Mike Slade. Slade came to see me a few years after we had started, and he described the video ads that will run on the website. Video ads that will pay for everything. I said, video ads, genius. When can we start? The answer was, well, how about a few years from now? And when will be widely available? Who knows? You know what? We're getting a lot of who knows right now about the promise of generative AI. Who knows? So we tend to dismiss it. But if we could just get to the promised land, it could be like streaming video, huge, game changer, gigantic possibilities. Right now at this moment, everything is on the verge. But what's before the verge? Well, the answer is all sorts of inflationary numbers that may drive up interest rates, making us feel like it's too dicey a moment to invest in stocks. It feels like that moment when Starwave visited thestreet.com. My response to Starwave Vision was, great, that's great. How am I going to make it, though, until we get to the promised land of video and get rid of these flat banner ads? We're going to be crushed by the first outfit that disintermediates the ad agencies that love us so much. Sure enough, we got obliterated as .com bubble burst, and Google took over the ad game, disintermediating every advertising from no more wine and dine campaigns. No. All the predictions we made about the internet during the period turned out to be true. But it took a decade longer than the visionaries had hoped. Right now, AI is promising in the same way. But we've got this near-term inflation issue that we can't do anything about. The cars, the insurance, the homes, the apparel, the rents, these are all working against us and could cause the bond market to behave badly, making the Fed, in turn, feel like it needs to leave rates higher for longer. And that will impact stocks. I don't care what you say. So let's bring this all together. I would love to believe that AI will produce amazing gains in productivity that will help bring down inflation and bring it down hard. It could make things cheaper. It could improve the consumer's balance sheet. But it can't bring down the cost of what's currently too high. If this were a Western film, instead of just the stock market, AI would be the cavalry. Stocks would be stuck in the fort. The fort can keep lots of bad actors out, help us go higher, but it can't create the goods that are in short supply. As long as rates are high, the home builders won't put up many new homes, even though demand is off the charts. Cars and trucks, they're all dazed by the fact that we're no longer going toward the electric vehicle future everybody expected. So we can't ignore the near term and focus on recursion and its ability to reinvent drugs using NVIDIA supercomputers. We can think about how great it is that a bedtime story can be sung by a computer, perhaps in a baritone, perhaps by someone sounding like Taylor Swift. But we can't get the inflation indices that control the Fed's worldview under control, which is why you need to stick with the stocks of companies that aren't hostage to interest rates, which means you have to be wary of ultra growth stocks. Those do poorly when rates go higher. And you don't want to get hurt by a slowing economy, like by buying the stocks of goods directly connected to housing. Otherwise, you can lose money. So here's the bottom line. We got to streaming video eventually, and I think we'll create drugs faster too. But the former took too long, and the latter, who knows? But it certainly won't be in time to save us from Wednesday's CPI report. Let's just hope it comes in cool, and it doesn't matter. Miles in Louisiana. Miles.
Hey, Jim, I have a small position in Visa and was looking to add to it. Is this a good level, and should we be concerned about rising credit card debt?
No, because it's really, that would be, a bank would be worried about the credit card debt, not Visa. People just be issuing more and more cards. I think Visa, this is a fabulous level to get in. You're down 11 from its high, but that's about all you ever seem to get when it comes to Visa. I would be a buyer. Tom in New York. Tom.
Hello, Mr. Cramer. Thank you for taking my call.
Of course, Tom. How can I help?
Quickly, Jim, I've been investing for some time without a whole lot of success. So recently, I really became fed up with buying high and selling low. So I broke down and joined the investing club.
Oh, thank you. I like that. Thank you very much.
I feel that you guys have gotten me pointed in the right direction.
Me and Jeff and Zev.
Yes, sir.
Unbelievable
yes,
team. And Jeff is just incredible in this stuff. Go ahead.
Yes, you are. All of you. I'm learning to do my homework.
Okay.
But as a fledgling club member, I thought it wise to check my homework with the teacher.
Sure.
So, Jim, I have a small position in one of your Cramer faves, and I wanted to know if it's too late to increase my position. And Eaton, even though the current price is a little above my basis.
Eaton is a great stock. It trades erratically. So that means that there are these moments where it goes down like 4 or 5, and you get to buy it. You have to put in an order for if it drops 4 or 5, you can buy some for that day. Don't put it good till can just that day. And then if it falls even more than that, you can buy some more. But you got to wait because it's a crazy trader. So we got to wait for it to climb. All right, we can get excited about all these AI innovations, right? But we still can't get near-term inflation under control. So if you want to actually make money, you need to stick with the stocks of companies that aren't hostage to interest rates or a slowing economy. On Mad Money Tonight, where do we stand on the gig economy stocks now that some of the key players have rallied off of their lows? I'm serving the likes of Uber and Instacart and sharing if I think the momentum could continue. Then, we've been covering the Constellation Energy story for 2 years, CEG. So with the stock rallying from 50 to over 200 today, is there more room to run? I'll give you my take. And the power of the buyback is real. I'm sharing a buyback big shot that might be worth adding to your shopping list. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Where do we stand with the gig economy? Ever since the market bottomed in October of 2022, the likes of Uber, Lyft, and DoorDash have been on fire. And the newly public Maple Bear, that's the parent of Instacart, finally started roaring this January. But then the market cooled on growth stocks in March and April, and these gig economy names pulled back from their highs, pulled back dramatically, actually. All of a sudden, these companies had a lot to prove with their first quarter reports. And now that we've heard from them, I want to give you an update on the gig economy, starting with the rideshare plays and then going over to the delivery services after the break. Keep in mind, until a few years ago, none of these companies really had to care about profitability. It wasn't in the cards. The whole industry was propped up by endless venture capital money. Endless because the Fed kept interest rates so low for so long that it was insanely cheap for these companies to borrow money. That all changed when the Fed started tightening in 2022, and the gig economy plays had to pivot to profitability. As a result, all of these services became a lot more expensive. So how are they handling the new world? Why don't we start with Uber Technologies, the number one player in ride sharing with 76% market share and a heavy hitter in the meal delivery space, 23% market share, way behind DoorDash, though, but much higher than anybody else. Under the leadership of CEO Dara Khosrowshahi, Uber's stock rallied from $20 at its lowest to a couple of years ago to above $80 at its highs in March before pulling back to $66 today. The stock could soar like that because these guys figured out how to deliver profitable growth. When Uber reported in February, they delivered blowout numbers and followed that up a few days later by announcing a $7 billion buyback. Wow, first in its company's history. Then growth stocks went out of style, as I mentioned, in March and April. The stock gave up a decent chunk of its gains, and everybody started worrying about the fundamentals. But the fundamentals, they turned out to be fine. When Uber reported last Wednesday, I thought the results were mostly pretty good. Revenue beat, EBITDA beat, massive free cash flow beat, with the latter up 148% year over year. There were some issues, though. Starting with the fact that Uber's gross bookings missed thanks to a shortfall in the ride-sharing business. Ooh, bread and butter. Plus, on the earnings front, well, they lost 32 cents. That was a surprise loss. Wall Street was looking for a 22-cent profit. Now, I don't blame them, though. CEO Dara Khosrowshahi explained that the loss came primarily from a markdown for Uber's equity stakes in other companies. Like the ride-sharing company in China, they had DiDi Global. It had nothing to do with the core business, so it should have been ignored. Management's guidance for the current quarter was technically mixed, though. But it certainly didn't help. Bad gross bookings forecasts, inline EBITDA forecasts. That was not good. I think it was this softness in the gross bookings that sent the stock down 5.7% last Wednesday, because it seemed to confirm the consumer weakness fears that they've all been festering on Wall Street. You hear about that all the time, right? How weak the consumer's gotten. On top of that, maybe people wanted to hear more about what Uber's got for autonomous driving, given all the noise Tesla's been making about its robo-taxis. But Khosrowshahi basically said autonomous vehicles aren't happening anytime soon. Wow. Overall, though, I got to tell you, even after that, I'm pretty sanguine about the prospects of Uber. The bull thesis here is that the company is consistently growing profits and throwing off tons of new cash flow, even if there's some softness on the gross bookings front. In the end, I'm viewing this post-first quarter shakeout as an appropriate reset of expectations. Plus, even after Uber's pulled back to the 60s, the stock remains up more than 7% year to date. And hey, this sell-off also gives management a chance to put that big buyback to work. You got my blessing to buy it because the company will be buying right alongside you. I really like the stock here. As for Lyft, LYFT, the underdog in ride-sharing space, well, you know what? They had another solid quarter under newest CEO David Risher when they reported last Tuesday night, the night before we heard from Uber. And you remember David. He's been on the show a bunch of times. In fact, Uber's gross bookings miss looms so large precisely because Lyft's gross bookings beat expectations. Looks like they're finally on a more competitive footing. Lyft's gross bookings growth matched Uber's in the first quarter, and Lyft's guidance for second quarter bookings implies they'll match Uber yet again. In the old days, Lyft seemed to be steadily losing share to Uber. It now basically seems to be holding steady, which is an extremely positive development. And the good news is that they're defending their market share without compromising profitability. Lyft reported a modest EBITDA beat and surprisingly positive free cash flow for the second quarter in a row. Good guidance on the profitability front for the current quarter, too. How are they doing it? Risher credited solid execution and innovation on the platform for the much improved numbers. I like it. I think he's right. I accept that as the main reason. As for its full-year forecast, Lyft mostly confirmed its previous outlook, except they raised their free cash flow guidance pretty substantially. That's exactly what you wanted to see. But the takeaway is that Lyft continued to make progress towards the goal of becoming a profitable growth story, which is what Richard's been aiming for since he took the reins about a year ago. The results were good enough to send the stock up 7.1% last Wednesday, though Lyft has given back some of that gain since then. I have been really impressed with what Richard's done in his first year of the job, and the stock definitely deserved to rally in response to the strong quarter, especially since it looks like Lyft has stemmed the share loss to Uber and done so without compromising profitability. I bet the stock can work higher as long as those narrative remains in place. In fact, as long as Richard continues to turn things around, I actually wouldn't be surprised if Lyft even became a takeover target if the stock stays down here while the big turn comes. After all, it's the smallest of the major gig economy stocks with a sub-$7 billion market cap. So the bottom line for the two major ride-sharing companies is that both reported solid quarters, even if Lyft's was well received while Uber's was hated. Going forward, we have to keep an eye on whether Uber has an unaffordability problem. But for now, I'm not going to give up on this one just because of some gross bookie softness. Not when they're delivering so well on the profitability and free cash flow front. Lyft's more of a turnaround story, but turnaround's going great. And if you want to know about the delivery side of the gig economy, why don't you stick around after the break, because we can tell you all about it. Mad Money's back.
Coming up, Cramer continues his look at the gig economy, where to invest in the new age of work. Next.
Tonight we're doing a roundup of the major gig economy plays now that they've all reported. Now, before the break, it was the ride-sharing companies. Now I want to talk about two major players in food delivery, DoorDash and Maple Bear, the parent company of Instacart. Let's start with DoorDash because it was the first of these companies to report. The food delivery service company delivered a solid quarter with seemingly grim guidance. That sent the stock down more than 10% the next day. The actual quarter was good, but management guided for slightly lower earnings before interest, taxes, depreciation, and amortization in the current quarter, largely because they're making big investments in grocery and convenience store delivery while expanding overseas. Given all the hand-wringing we've heard about the flagging strength of the consumer, I wanted to see if people were backing away from DoorDash, as all these food delivery services have become major sources of inflation. But I didn't see much evidence of demand slackening in the quarter, and the guidance doesn't reflect that either. They're just making some big investments in order to bolster the company's growth in the second half of the year and beyond. I like that. But Wall Street simply wasn't willing to wait for these investments to pay off. Just like with Uber and Lyft, DoorDash have been able to rally over the past 18 months, but because the company pivoted to profitable growth, and I love that. Less spending, more monetization of the existing business. So when people saw the new spending plans, they felt like maybe it was a step back in the old wrong direction. Personally, I think DoorDash deserves the benefit of the doubt here, but at the very moment, there's very little patience for a new investment cycle, which is what the company seemed to be telegraphing. Now, after the stock's initial 10% decline, it tried to mount a comeback. But then last Tuesday, we learned that Uber and Instacart are teaming up to bring meal delivery to the Instacart app, basically a new portal for Uber Eats to bring in customers. While Uber Eats is a long way behind DoorDash in meal delivery market share, this obviously makes them more of a competitive threat, and that erased the stock's rebound. In the end, I got tremendous respect for DoorDash co-founder and CEO Tony Xu. And like I said, my gut instinct is that the company deserves the benefit of the doubt as it spends more to grow the business. But the stock might be choppy until the company demonstrates the earnings improvements that have been promised for the second half. I think DoorDash is worth your trust. Just don't expect it to earn the market's trust anytime soon. I'm out ahead of it. Next, let's look at the last report for the four major gig economy plays, the one that's most mystifying to me, the one which came from Instacart, parent Maple Bear. That's right. So in other words, Maple Bear is the parent for Instacart, even though you probably never heard of Maple Bear. And this came Wednesday night. Now, this stock had made a huge move higher earlier in mid-February, thanks to a much better than expected quarter. On top of reporting strong numbers, the company announced a slew of efforts as part of a major pivot toward profitability and rewarding shareholders. That includes the departure of the company's COO, a restructuring plan with a 7% cut to the workforce, and even a $500 million plan, an increase to the previously announced share repurchase authorization. That brought the total buyback to $1 billion. That's pretty big for a company that's valued at less than $10 billion. I really like that. Reading between the lines a bit, the sentiment seems to be this. As Instacart shares fell from 42 and change on their first day of trading down to 22 and change at their lows in early January, management realized the stock wasn't resonating with Wall Street. So what did they do? They did what you do to get things going. They took some major steps to make the business look more like Uber or DoorDash, which have both been rallying since 2022, precisely because of their pivot to profitable growth, rather than growth at all costs, which is a loser. And that's what allowed the stock to work from February through its highs last month, although it never pulled back as much as the other gig economy names. I got to tell you, the plan worked, because when Maple reported last Wednesday, the quarter looked awfully similar to the one everybody loved back in February. Gross transaction value higher than expected. Orders substantially higher than expected. Revenue higher than expected, with accelerating growth in transaction volume and orders. Even better, Maple Bear's adjusted EBITDA came in well ahead of the expectations again. And the company delivered another big surprise profit, making 43 cents of earnings per share, when analysts were looking for a 2-cent loss. Better yet, management's guidance for the current quarter was in the high end for gross transaction volume and was flat out better than expected for EBITDA, substantially so. In response, the stock opened higher last Thursday morning, as you would expect, right? But it eventually gave up those gains and then some, ending the day down 3.7% and then tumbling another 3.1%.
The House of Pain.
On Friday. So the stock's now back under $35, but for some perspective, Maple Bear's still up 48% year to date. Why did the stock react so negatively? Isn't this this is really a terrific conundrum to me. Now, I could try to parse every line of the quarter in the guidance, but honestly, the post-IPO lockup on insider selling just ended in March. So you had to expect some profit taking here, no matter how good the numbers were. Remember, it's up 48%. The real reason I hesitate to wholeheartedly recommend Instacart's parent company is that I'm just not sure how the grocery delivery space is going to work out in the long run. Sure, they paired up with Uber to offer their own meal delivery service, but they need to do that because 3 weeks ago, Amazon announced a new low-cost grocery delivery subscription for Prime customers. Nearly 7 years after Amazon announced its acquisition of Whole Foods, it still really hasn't nailed down grocery delivery. This is just their latest attempt. But I don't think they'll ever truly stop trying. And in the end, well, you don't want to compete against Amazon. After all, like Liam Neeson in Taken, Amazon has a very particular set of skills that are a nightmare for companies like Maple Bear. So here's the bottom line for the entire gig economy space. After hearing from all these companies, what I see is a confusing situation. Uber, DoorDash, and Instacart are all lower after earnings, while Lyft managed to gain a bit of ground. But the reality is a lot more complicated than that. All 4 companies reported solid results, but Uber had some gross booking softness that sent it lower. While I still like it, it needs to be monitored. Lyft's very much doing well. I believe in DoorDash. It might take a little while to pan out. As for Maple Bear, the parent company of Instacart, it's still too early for me to get behind this one, especially with Amazon desperate to take over the online grocery delivery space, and I think they have the horses to do it. Let's go to Rob in Kentucky, please. Rob.
Jimmy C., the chairman of Chill.
Whoa, man, I like that. I like that a lot. Chairman of Chill. Yeah.
I have a sizable position in Cedar Fair. With the impending merger with Six Flags, should I stay on this roller coaster for one more ride or get off now and wave the white flag?
Well, what if, look, this stock just had a major run, and its yield is not that great here. I want you to sell half. Just sell half, okay? Not more than that, but you got to sell half because it just had a parabolic move. Parabolic moves are dangerous. You sell half, let the rest play, and you will probably be playing with the house's money. I like that. That's Dr. Chill, please. Jan in California. Jan.
Yes, thank you for taking my call, Jim. My question is regarding the Kava Group. Mm-hmm. And you recently said that this could possibly be the next Chipotle. And today it took quite a big dump. And I'm wondering if you think this is company specific or the restaurant segment that it's in, such as something like Rival Sweetgreen.
Well, I'll tell you, it's an interesting question. I think you're going to get, anytime you have a move, the way Kava has moved, which again is this parabolic move situation, this stock's up 77% for the year. So you got to believe that there'll be some people who say, you know what, just ka-ching, ka-ching, ka-ching. And that's what you're experiencing. It wouldn't be surprised if that didn't go down to 70. It's had such a big run, but I'm sticking by my view that it could be another Chipotle. Let's go to Chuck in North Carolina. Chuck.
Booyah, Jim.
Booyah, Chuck.
Thanks for taking my call. I have a small position in Chipotle and would like your short and long-term opinion, and also whether I should add more to my position in Chipotle.
Okay, I think Chipotle is fantastic. I have to fight you on buying more here because it is so close to its high, but just hold it. and don't make any sales because it's going to split, by the way, in June. You're getting a lot of stock. People are going to get excited about that. We might even actually trim some a little when it gets to that. But I think Chipotle fundamentals are just fantastic. What great callers. Thank you so much, everybody. All right, the gig economy sector is a confusing space that requires some more monitoring on a case-by-case basis. I do still like the stock like Uber, but I'm kind of wary of Instacart. All right, much more Mad Money ahead. With crude and natural gas prices beginning to tick higher, could now be the time to invest in a name like Constellation Energy, which a lot of you are crazy about. I'm going to update my thesis because we've loved for so long. I've got to figure out what to do now. Then buybacks don't get enough credit for the impact they have on a stock. I'm revealing the names of a few companies with the right buyback discipline that could help you make some money. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. Lately, this market's insane. It's been dominated by the utility stocks. And as of close observers in Mad Money know, there is no utility I like more than Constellation Energy. The independent power producer gets the bulk of its energy from nuclear plants with renewable kickers. Remember, Constellation CG was spun out of Exelon in March of 2022. I've been recommending it practically the whole way, starting when it was trading at 53 and change. 213. Not bad. Better than sharp stick in the eyes, I like to say on Wall Street. Now, I knew this was a great story from the beginning, but the crazy thing about Constellation is that at every turn, the story just keeps getting better. Not long after my initial recommendations, Congress passed the Inflation Reduction Act, the IRA, which did very little, of course, to reduce inflation, but included some gigantic subsidies for the nuclear power industry. Plus, over the past couple of years, there's been a growing acceptance that nuclear energy is really the only reliable option to wean our economy off fossil fuels at scale. That's the key word, at scale. Because wind and solar are great, but they don't operate 24/7. Nuclear's always on. Even better for Constellation, oil prices have been creeping higher in recent months, and even natural gas has climbed off multi-year lows, making nuclear more competitive on price. It's just one good thing after another here. In its first 2 years as an independent company, Constellation's earnings for interest, taxes, depreciation, and amortization, the key metric for a capital-intensive utility, nearly doubled. Now, when Constellation reported its fourth quarter numbers at the end of February, management announced that they were switching from EBITDA as the key metric to operating earnings because the Inflation Reduction Act's new nuclear energy production tax credits had just kicked in. And it's easier to account for using operating earnings. Wow. It's clear Wall Street they had no idea how great this IRA thing would be because Constellation guided for $7.23 to $8.03 in operating earnings per share this year. Wall Street was looking for $6.51. Remember, this is utility stock. What a beat and raise. Management also said they expect to grow this number a 10% plus clip for at least the rest of the decade. That is hugely positive. I mean, it's probably one of the greatest growth stories of our time. No wonder the stock ran from 133 and change before the quarter to around 170 in the 2 days after the report. Crazily enough, Constellation barely got more expensive as it made that move before the quarter. It was trading 20.5 times this year's earnings estimates after the rally. It was trading 22.4 times the suddenly raised estimates. You see, this kind of thing happens all the time with growth stocks, but it's rare to find this kind of action in a utility, even if it is a growth utility. Then, as Constellation kept running throughout March and April, reaching the 190s, even I started wondering if the stock was getting ahead of itself. But tonight, I want to hit the story again because Constellation Energy just reported first quarter results last week, and believe it or not, they managed to surprise expectations again. In fact, this is one of the single best reports that we've seen this earnings season, hence why it sent the stock to new all-time highs. First, let's start with the numbers, which were once again excellent. The new key metric, operating earnings, now remember it's not EBITDA anymore, came in at $1.82 per share. Wall Street was only looking for $1.30. Isn't that incredible? But dampening enthusiasm a tad, was the fact that Constellation declined to raise its full-year forecast for this line item. But at this point, does anyone believe that Constellation will come in below its own forecast? After following this company closely for the past 2 years, I highly doubt that. Constellation also added another $1 billion to its buyback, bringing the total authorization to $3 billion. They've already repurchased $1.5 billion worth of stocks so far this year, which is another reason why those things run so much. Clearly, management agrees with me that the stock's still a bargain. What's more interesting to us is the story behind Constellation's ever-improving numbers. Right now, it's thanks to surging demand for carbon-free power for data centers. On the conference call last week, CEO Joe Dominguez talked about several growth drivers for nuclear power, including electric vehicles, electric heating, and the reindustrialization of North America. This is such a reindustrial play. It's incredible. But it's clear that the growth of data centers is the big one. As Dominguez told us on the call, quote, the data economy and Constellation Nuclear Energy go together like peanut butter and jelly, end quote. He said that his company is, quote, in advanced conversation with multiple clients, large, well-known companies about powering their needs. These deals take some time, but could be finalized soon. No wonder Constellation is so confident it can put up double-digit operating earnings growth for the years to come. No wonder the stock's the third best performer in the S&P 500 this year, up 82%. In order to meet all these newfound demand, Constellation is trying to extend the life of its existing nuclear sites, ideally to 2060 and beyond. But they're also talking about adding new capacity, primarily at existing sites, because the demand is that strong. That could include adding smaller next-generation nuclear units at specific sites, some earmarked for specific clients. When pressed for more details on that subject later in the call, Constellation's management team said that it received a request from information from Google, Microsoft, and Nucor Steel. That's two of the three major cloud vendors and the nation's top steel maker. While these aren't signed deals, at least not yet, it's clear that there are tons of major companies who desperately need reliable, clean energy, so their only real choice is nuclear. Oh, let me whisper something at you. They're even talking about reopening 3 Mile Island, just the one that closed in 2019, but who the heck knows with these guys? At the end of the day, Constellation Energy has been one of my single greatest picks in recent years. But you've had to stay close to the story along the way, because the story keeps evolving, and evolving for the better. First, Constellation was all about potential and basically scarcity value for those of us who believe in nuclear energy, but realized there were a few pure plays on it. Then the Inflation Reduction Act passed, and the bull case got even better, including new subsidies for nuclear, making Constellation's product a lot more competitive for corporate customers who already wanted carbon-free electricity, and now they can get it on the cheap. This year, the story evolved further as we started to get an idea of just how profitable these subsidies would be for the company. And now we're getting much more visibility about the drivers of demand in the future, including the insane demand for clean power for data centers, which we're putting up like crazy to feed the AI machine. That demand's gotten so strong that major companies are now imploring Constellation to add modern nuclear new power plants at existing plants. A few years ago, we wondered legitimately if any more nuclear power facilities would be ever built here in the U.S. because it was so unpopular and because of the overruns of Southern SO. Now we're just wondering if we can build new ones fast enough. Bottom line, forgive me if I remain bullish on Constellation Energy, even after its stock has rocketed higher. Despite the run from $50 to above 200, we somehow still seem to be in the early days of this story. It's been incredible to witness. And again, I think it's got the legs to go higher still. Mad Money's back after the break.
When we return, master the markets one stock at a time. The lightning round is up next.
It is time to the light round. That's our Rock Card Loaners. I tell you buy, sell some typically, or of course, there's always everything. Plan to sell. And then the lightning round is over. Are you ready, Ski? Time for the lightning round. Let's start with Steve in New York. Steve.
Happy Monday, Professor. How you doing?
I'm doing well. How about you, partner?
I'm good, thank you. So I wanted to ask you, with the potential for rates coming down, I would like to collect some more yield in my portfolio along with capital appreciation.
Okay.
I was wondering if you could share your thoughts with me on AllianceBernstein, ticker symbol AB.
Very well-run company. Always surprised that it is as inexpensive as it is, which is why you've got that big yield. So I would do support that idea. Let's go to Richard in Georgia. Richard!
Booyah, Jimmy Chill, and happy Monday.
Oh, same to you, man. Got a full week ahead of us. Fantastic. What's up?
I'm ready. Let's go. Hey, big shout out to your crew. They are fantastic.
Make me look fantastic every single day. What
they
can I do?
Deserve a raise, my friend.
Oh, I wish and I would write them all checks, but that's not allowed. All right.
All right, Jim,
They like that, by the way.
I need some help with this stock.
Sure.
I need to know whether to hang on. I know it doesn't matter where it's been and only where it's going.
Right.
So I can't cry about what it was. But where is it going? Do I need to hold on to it, or do I just need to find a better opportunity? And the stock is C8H, Cardinal Health.
Okay, it's been a great quandary because, McKesson's been unbelievable. Sencora's been fantastic. Jason Haller came on the show. I thought he told a really good story, and then the quarter was terrible. So let me do this. Let me do this for you, okay? Let me have him back on. I want to know what happened because I don't get it. All the other companies are doing incredibly in that industry. Let's learn more. Now I need to go to Gregory in California. Gregory.
Jim, you, Jeff, and the gang are really just hitting all the marks this year with the club. I've been a member for a long time.
See, club members happy. Thank you.
Oh, I love the piece you wrote on the restaurants over the weekend.
I like that.
Thank you. Question of today's
inflation beaters, inflation fighters, and inflation lovers.
So this software company that I'm calling about today, they bucked the trend of all the others and beat the street. What do you know last week? How high do you think it can go? And that is, if it's all coming together and flowing for Confluent.
Confluent, oh my God. I mean, look, Gregory's so right. If this thing gets together, this thing could just be a rocket ship. But if it doesn't, I'm going to have to say, I think the chances are that it doesn't. And I'm not going to recommend the stock here, but thank you so much for the kind words. Let's go to Josiah in Florida. Josiah.
Thanks for taking my call.
Of course.
Yes, PSTG, Pure Storage.
Yeah, this is a fabulous company. It's funny because the previous stock was one of the guys said to get it together. It could be huge, if not otherwise. This company struggled to get it together for years, and they have gotten together now, and I have to hand it to them. They stuck with it, and Enterprise Storage Solution, I typically don't recommend them. I do like Pure Storage. Joanna in Pennsylvania. Joanna.
Yes, hello, Mr. Cramer.
Joanna, how are you?
I bought a stock quite some time ago, and have since sold it, but it was MicroStrategy, and it was $1,900, the all-time high.
Woo.
And then it started to sell off, and it's down somewhere in the 1,300s now.
Right.
It's lost $600.
Okay, well, Joanna, all this company really is, just to be clear, it trades off of Bitcoin because Michael Saylor, who runs the company, he just buys Bitcoin. And I think that's what happened is it's accentuated Bitcoin. I always tell people, if you want Bitcoin, don't buy MicroStrategy, buy Bitcoin. And that's what I think you are in, and that's what I think you should do. Let's go to Tori in Louisiana. Tori.
Booyah, Cramer.
Whoa.
So we've
Great
held
to have you.
ABAZ for months, and we're up big. I know they were just selected for Replicator last week. I'm just wondering, should I keep holding?
Oh, yeah. No, we've been behind AeroVironment forever. And the reason is because if they make drones that are much less expensive than the other stuff that the military buys, if we're going to win in the wars that we're involved in, we need cheap drones, not the real expensive stuff, because the real expensive stuff you can't make fast enough, and it's just going to bankrupt our budget. Let's go to Pete in Connecticut. Pete.
Hey, Jim. How are you? Thanks for taking my call.
I'm doing good. How about you?
Good. Hey, thanks for all your education. First time, long time.
Thank you.
My question is on a small position I have with STRL. Sterling Infrastructure.
No, every one of these is going to be the same thing, whether it be PWR or whether it be CRH we had the other day, Sterling. These are infrastructure plays that are working because that money is starting to pour in from the federal government. That's why that's a winner. I need to go to Ronnie in Delaware. Ronnie.
Hi, Jim. Thank you for taking my call.
Oh, my pleasure.
My question is about Nu Skin and US.
Yeah, you know what? I've had the personal care space is very, very difficult, and that is not the one you want to be in. It is an overvalued stock even at these prices. Let's go to Sharon in Minnesota. Sharon.
Booyah, Jim.
Booyah.
So I'm trying to see if you think Oracle is best of breed and if you think it's a good, reasonable price to buy here.
A lot of people call and say good things about the club. I want to talk about Oracle. I got Oracle wrong. I two quarters in a row, I thought they were going to do it big, and then they didn't, and I felt that it was wrong to continue to hold it. I sold it at a bad price. I have to defer to others who know Oracle better than I do. That's how I like to look at it. Let's go to Greg in Florida. Greg.
Hey, Jim. How are you?
I'm good. How about you?
Good. Thank you for taking my call, and hope you and your family had a wonderful Mother's Day yesterday.
We had a good Mother's Day. We actually had a good one. Thank you.
Watch your show almost every night, and really appreciate your daily insights.
Thank you.
It's invaluable. I'm calling tonight regarding stock symbol ALB.
Yeah, that's lithium. No, anything connected with the EVs right now is a no-go. That stock's going to just mark some time, maybe go up a little bit. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, a tool of financial engineering that can sharpen your portfolio. Where the buyback is making its mark. Next.
When we talk about why stocks go higher, we don't spend enough time, you and me, accounting for buybacks. Periodically it comes up. Last month, AutoNation, the car and truck dealer, reported a pretty good quarter, leading to yet another leg higher for the stock that's rallied from $20 at the thick of COVID to more than $168 today. Sure, a lot of that comes down to the fact that business for cars has been pretty consistent, simply because there haven't been enough of them, until right about now. But I don't think AutoNation stock has truly been propelled by stronger vehicle prices. It's not the net income, which has vacillated between $930 million, $1.3 billion for the last couple of years. It's not the sales, which have gone up, but not by much. Certainly nothing scorching. No, I think it's AutoNation's buyback that's been driving this one higher. The company's share count has shrunk from, this is pretty amazing, from just under 90 million shares in 2020 to around 40 million now. Knocking down the 40, they repurchased more than half the stock, for heaven's sake. The share count fell by more than 3% this past quarter alone, and by almost 12% this past year. Gigantic. Plus, AutoNation just announced a new $1 billion buyback. I mean, come on. Ridiculously huge. The company's only a $6.8 billion company. These guys don't even make a big deal of it, other than to say that they're balancing the repurchasing with that leverage and mentioning that they paid $250 million for the stock they repurchased this past quarter. Much of the conference call was really devoted to the auto industry, as people would expect, right, including availability trends for new and previously used cars. Obviously, there's some chatter about interest rates, the hybrids, the usual. But the most enlightening question on the call came from a fellow by the name of John Murphy, a bank market analyst, who noted, first, quote, your stock is incredibly inexpensive, quote, unquote. And then he went on to say that he was curious about, quote, how the decisions are getting made on sort of the speed and sort of ratios to the buyback, end quote, which is what everyone really was thinking. The answer Murphy got was pretty matter of fact. I mean, I think it's why buybacks don't get the attention they should. AutoNation basically said they have a plan in place that uses a grid, and the grid kicked in at the end of the quarter, causing them to buy a lot of stock. They didn't articulate what the grid holds, where the buybacks gets bigger, where it gets really big. Instead, they emphasize that they're circumscribed in what they can do because of the law. Buybacks need to be more or less automatic, or else it's too easy to manipulate your own stock price. In the end, AutoNation's CFO, Tom Slozak, explained that, quote, our opportunities were somewhat limited, but it does remain a key part of our capital allocation strategy. You won't hear me criticize any company with that big a buyback, one that's made so much money for shareholders. But I think there should have been more of a recognition that AutoNation's incredible success fuels the buyback, which in turn fuels its stock success. And in the end, that's all we really care about. It's something that makes a ton of sense when you consider this stock sells for just over 8 times next year's earnings. These guys are really good operators. It'd be 16 times earnings if they still had the same share count that they did in 2020. But in the hedge fund world that I came from, I think I would have added the following on the conference call. As long as there are stupid idiots who'll sell the stock of our terrific company down at these ridiculously low levels, we will keep buying it back because it's much easier to make money for our shareholders than selling cars and trucks. I like to say there's always more market sober. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.